This is not investment advice. That statement is not a legal disclaimer to be skimmed and forgotten. It is the foundation of everything that follows. The question implied by this title, what would someone acquire if starting from zero, cannot be answered responsibly with specific recommendations. Circumstances differ, risk tolerances differ, financial situations differ. What serves one person may harm another, but the question can be reframed. Instead of asking what to buy, we can ask, what principles have historically guided those seeking to hold value outside the paper financial system? What characteristics distinguish monetary metals from other assets? What has mattered during periods of monetary stress? And what has proven irrelevant? These questions have answers grounded in history rather than speculation. They provide a framework for thinking rather than instructions for acting. The framework is what this examination offers. What anyone does with that framework is their own decision, made with their own judgment, suited to their own circumstances. This is not advice. This is education about principles that have persisted across centuries of monetary history. The first principle is understanding why precious metals exist in a portfolio at all. There is a common misconception that gold and silver are investments, assets purchased with the expectation of price appreciation to be sold later at a profit. This framing is not entirely wrong, but it misses the essential function. Gold and silver are not primarily investments. They are insurance. Insurance against the failure of paper systems, insurance against currency debasement, insurance against the institutional risks embedded in every other financial asset. When you purchase fire insurance for your home, you do not hope for a fire. You do not expect the insurance to generate returns. You accept the cost as protection against a catastrophic outcome you hope never occurs. Precious metals function similarly. The hope is that they are never needed. The hope is that currencies remain stable, that banking systems remain solvent, that the promises embedded in paper assets are honored. But hope is not a strategy. And history suggests that the hope is not always fulfilled. Every fiat currency in history has eventually failed or dramatically devalued. Every banking system has eventually experienced crisis. Every generation has witnessed at least one monetary disruption that rewarded those who held assets outside the system. Precious metals are the insurance against being caught without alternatives when such disruptions occur. This framing matters because it changes how allocation is considered. Insurance is not about maximizing returns. It is about ensuring survival of the portion allocated, regardless of what happens to everything else. The question is not, will gold go up? The question is, if everything else fails, what will still hold value? The second principle is the distinction between gold and silver. Gold and silver are both monetary metals. Both have served as money for thousands of years. Both exist outside the paper financial system. Both cannot be printed, debased, or defaulted upon. But they are not identical. Understanding their differences informs how each might serve different functions. Gold is the senior monetary metal. Central banks hold gold as reserves, over 35,000 metric tons across global central banks. Gold's market is deep and liquid. Gold's price movements are relatively stable compared to other commodities. Gold is recognized universally as a store of value. Gold serves those seeking maximum stability and universal recognition. It is the monetary metal of institutions of large-scale preservation of wealth that must survive across generations. Silver is the junior monetary metal. Central banks do not hold silver as reserves. Silver's market is smaller and more volatile. Silver has substantial industrial demand that gold lacks. Silver's price movements can be dramatic, both upward and downward. Silver serves those seeking accessibility and potential leverage to monetary conditions. An ounce of silver costs a fraction of an ounce of gold. Accumulation is possible at smaller increments. The same dollar amount purchases more physical mass, more tangible presence. Silver's volatility is a characteristic, not a flaw. During monetary stress, silver has historically outperformed gold in percentage terms, sometimes dramatically. The 2010-2011 period saw silver rise over 400%, while gold rose approximately 70%. But volatility cuts both ways. Silver falls faster during corrections. Silver tests patience more severely. Silver requires tolerance for movement that gold's holders do not experience. Neither metal is superior. They serve different functions. Understanding which function matters for a specific situation is part of the framework. The third principle is the distinction between paper claims and physical possession. There are many ways to gain exposure to precious metals: exchange-traded funds, mining stocks, futures contracts, allocated storage accounts, unallocated storage accounts, and physical metal in personal possession. These are not equivalent. Paper claims on precious metals carry counterparty risk. Someone else holds the metal. Someone else's solvency determines whether you can access it. Someone else's rules determine the conditions of access. ETFs hold metal in vaults managed by custodians. The custodians are typically large financial institutions. The fine print of ETF prospectuses contains clauses permitting cash settlement under certain conditions. The metal exists, but your access to it is mediated by layers of institutional infrastructure. Mining stocks provide leverage to metal prices but are not metal. They are equities in companies that extract metal. They carry operational risk, management risk, jurisdictional risk, and all the risks associated with any business enterprise. Futures contracts are promises to deliver metal at future dates. They are paper claims that typically settle in cash. They provide price exposure without physical possession. Allocated storage accounts specify that particular bars with particular serial numbers belong to you. This is closer to ownership, but still requires trust in the storage provider. Unallocated accounts are claims on a pool of metal. You own an interest in the pool, not specific bars. If the provider fails, you are a creditor, not an owner. Physical possession eliminates counterparty risk. Metal in your possession does not depend on anyone else's solvency. It does not require institutional infrastructure to access. It cannot be frozen, canceled, or subjected to rule changes by third parties. Physical possession carries its own costs and risks. Storage must be arranged, security must be considered. Insurance may be prudent, large quantities become logistically challenging, but physical possession is the form of ownership that matches the function of insurance. Insurance against systemic failure is not well served by assets that depend on the system for access. This does not mean paper claims are worthless. For trading, for convenience, for certain strategies, paper claims serve purposes that physical cannot. But for the core function, insurance against system failure, physical possession is the form that fulfills the purpose. The fourth principle is understanding what premium means and when it matters. Physical precious metals trade at premiums above the spot price. The spot price is the price quoted on exchanges, the price of futures contracts, the price that appears when you search gold price or silver price. When you purchase physical metal, you pay more than spot. The difference is the premium. Premiums cover manufacturing costs for coins and bars. They cover dealer margins. They cover the logistics of physical distribution. They reflect the supply and demand for physical metal specifically as opposed to paper claims. Premiums vary significantly by product. Government-minted coins, American Eagles, Canadian Maples, Austrian Philharmonics, carry higher premiums. The government guarantee of weight and purity commands a price. The recognizability facilitates future sale. Generic rounds and bars carry lower premiums. They contain the same metal, but without government backing. Recognizability may be lower. Verification may require more effort at time of sale. Large bars carry the lowest premiums per ounce. A 1,000-ounce silver bar or a kilogram gold bar approaches spot price most closely, but large bars sacrifice divisibility. Selling a fraction is not possible without cutting. The relationship between premium and function deserves consideration. If the purpose is insurance against severe monetary disruption, recognizability matters. In a disruption, the ability to verify authenticity quickly becomes important. Government-minted coins from major nations are recognized worldwide. Generic products may require assay. If the purpose is accumulating maximum metal for minimum cost, lower premiums matter. Generic rounds and bars provide more ounces per dollar. If the purpose is divisibility for potential future transactions, smaller denominations matter. 1-ounce coins can be exchanged individually. Large bars cannot. There is no universally correct answer. The appropriate choice depends on the function being served, the amounts involved, and the scenarios being prepared for. The fifth principle is understanding storage and security. Physical possession requires physical storage. Small quantities can be stored at home with minimal arrangements. A safe, a hidden location, a security system, the measures appropriate to any valuable household item. Larger quantities create different considerations. Home storage concentrates risk, theft, fire, natural disaster. Any event affecting the home affects the entire holding. Bank safe deposit boxes provide security, but reintroduce institutional dependency. Access requires the bank to be open and operational. Historical precedents exist of safe deposit box access being restricted during banking crises. Private vault storage offers security without banking system dependency. Facilities exist specifically for precious metal storage, often with insurance included, but this requires trust in the vault operator and ongoing storage fees. Geographic diversification, storing metal in multiple locations, potentially multiple jurisdictions, reduces concentration risk but increases complexity. There is no perfect solution. Each approach involves trade-offs. The appropriate approach depends on quantity, circumstances, threat assessment, and personal comfort with various risks. What matters is that the storage approach matches the function. Insurance against systemic risk should not be stored in a manner that reintroduces systemic risk. The sixth principle is understanding the difference between accumulation and speculation. Speculation seeks to profit from price movements. Buy low, sell high, capture the difference. Accumulation seeks to build a position over time without attempting to time markets. These approaches have different characteristics. Speculation requires judgment about price direction. It requires timing. It requires willingness to be wrong and adjust. Most speculators, across most markets, over most time periods, underperform simple accumulation strategies. Accumulation removes timing from the equation. Regular purchases, regardless of price, build a position over time. Some purchases occur at high prices, some at low prices. The average cost reflects the average price over the accumulation period. For precious metals serving as insurance, accumulation aligns better with the function. Insurance is not about timing. You do not purchase fire insurance only when you believe a fire is imminent. You maintain coverage consistently because you do not know when or if the risk will materialize. Similarly, accumulation of precious metals over time maintains monetary insurance consistently. Whether the price is high or low in any given month is less important than having the insurance in place when it might be needed. This does not mean price is irrelevant. Significant price increases reduce what can be acquired for the same dollars. Significant price decreases create opportunities to acquire more. But attempting to time purchases perfectly, waiting for dips, hesitating at highs, often results in acquiring less than consistent accumulation would have achieved. The perfect is the enemy of the good. Waiting for the perfect entry point often means having no position when the insurance is needed. The seventh principle is understanding the relationship between precious metals and the broader portfolio. Precious metals do not exist in isolation. They exist alongside other assets: equities, bonds, real estate, cash, business interests. The appropriate allocation to precious metals depends on what else exists. Someone with substantial equity exposure has concentration in paper assets that benefit from economic growth and suffer during contraction. Precious metals provide balance, assets that often move inversely to equities during stress. Someone with substantial real estate has concentration in illiquid, location-dependent assets. Precious metals provide portability and liquidity that real estate lacks. Someone with substantial bond holdings has concentration in fixed income instruments that lose value when inflation exceeds expectations. Precious metals provide protection against the inflation that bonds cannot survive. Someone with substantial cash has concentration in currency that loses purchasing power over time. Precious metals provide an alternative store of value that does not depend on central bank policy. The common thread is diversification, not in the conventional sense of owning many paper assets, but in the deeper sense of owning assets with different characteristics, different risks, different dependencies. Precious metals are the assets with no counterparty, no default risk, no dependence on institutional solvency. They balance portfolios concentrated in assets that carry these risks. The appropriate percentage varies by individual circumstance. Historical guidelines have ranged from 5% to 20% of total assets. But guidelines are not rules. Circumstances determine appropriateness. What matters is that precious metals serve a distinct function not served by other assets. That function justifies some allocation, with the specific percentage determined by individual factors no general framework can address. The eighth principle is understanding that doing something is different from doing everything. The scope of what could be done regarding precious metals is vast. One could research every product type, every dealer, every storage option. One could analyze historical price patterns, ratio relationships, mining supply dynamics. One could develop sophisticated strategies involving multiple metals, multiple forms, multiple jurisdictions. This comprehensiveness is not necessary for the insurance function. Insurance requires having coverage in place. It does not require optimal coverage, perfect coverage, or comprehensive coverage. Someone who acquires a modest amount of physical gold or silver, stores it reasonably securely, and maintains that position over time has achieved the essential function. They have assets outside the paper system. They have insurance against monetary disruption. They have something that will hold value if other assets do not. Whether they have the optimal product mix, the lowest premiums, the perfect storage arrangement, these are refinements. Refinements matter, but they matter less than having the basic function in place. The pursuit of perfection can prevent action. Analysis paralysis affects many who consider precious metals. They research endlessly, waiting until they understand everything, and meanwhile acquire nothing. Having imperfect insurance is superior to having no insurance while pursuing perfection. The framework suggests starting, acquiring something in some form, stored somehow, and refining over time. Learning by doing, adjusting as understanding develops. This is not advice to act carelessly. Due diligence matters. Understanding what is being acquired matters. But due diligence that never concludes in action defeats its purpose. The ninth principle is understanding that this is not about prediction. Nothing in this framework depends on predicting future prices. Gold may go up or down next month. Silver may spike or crash. The dollar may strengthen or weaken. The system may experience stress tomorrow or decades from now. None of these predictions are offered because none of them can be made reliably. The framework is based on principles that hold regardless of short-term price movements. Precious metals have functioned as monetary insurance for thousands of years. This function does not depend on next quarter's performance. Paper currencies have repeatedly failed throughout history. This pattern does not depend on predicting when the current currencies will fail. Banking systems have repeatedly experienced crises. This pattern does not depend on predicting the next crisis. The framework is about positioning based on historical patterns, not predictions about the future. Someone who holds precious metals is not betting that prices will rise. They are acknowledging that monetary systems are impermanent, that paper assets carry risks that physical metals do not, and that holding some assets outside the system is prudent regardless of what happens in any particular time frame. This acknowledgement does not require prediction. It requires only observation of history and recognition that the patterns of history have not been repealed. This framework does not tell anyone what to do. It does not specify gold versus silver, coins versus bars, home storage versus vault storage, large allocation versus small allocation. These specifics depend on individual circumstances that no general framework can address. What the framework offers is a way of thinking. Precious metals as insurance, not speculation. Physical possession as fulfillment of the insurance function. Premium and storage as practical considerations. Accumulation over timing as strategy. Balance with other assets as context. Action over perfection as approach. Principles over predictions as foundation. This way of thinking has guided those who have preserved wealth across monetary disruptions throughout history. It does not guarantee outcomes. Nothing guarantees outcomes. But it provides a foundation more reliable than prediction, more practical than speculation, more aligned with the function precious metals actually serve. What anyone does with this framework is their decision. The framework is offered as education. What follows from the education is individual responsibility. Gold does not rise. Confidence falls. Silver does not spike. Systems crack. Precious metals do not generate returns. They preserve value when other assets do not. This is not an investment thesis. This is a description of function. The function has been consistent across centuries, across currencies, across empires, across every monetary system that has risen and fallen throughout recorded history. The question is not what to buy. The question is what function needs to be served. Once the function is understood, the forms that serve it become clearer. Once the principles are understood, the specifics become matters of judgment rather than mystery. This is not advice. This is framework. What is built on the framework is each individual's construction. For those who understand the difference between being told what to do and being equipped to decide for themselves, the framework is offered. The decision remains yours.